Hello, this is Harjinder, and today we will be talking about Chapter 10, Standard Costs and Overhead Analysis. The specific learning objectives for this chapter include the ability to explain how standards are set for direct materials, direct labor, and variable manufacturing overhead. Calculate and explain the significance of the following variances: direct materials price variance and direct materials quantity variance, direct labor rate variance and direct labor efficiency variance, variable manufacturing overhead spending variance and variable manufacturing overhead efficiency variance, and finally, fixed manufacturing overhead budget variance and volume variance. We will also learn how to record journal entries for the standard costs and variances for direct materials and direct labor. So how are standard costs set for direct materials? The standard price per unit of materials represents the price that should be paid for a single unit of materials. This price includes the costs of shipping, receiving, and any other related costs, net of allowable discounts. The standard quantity per unit is the amount of materials that should be needed to complete production of a single unit of product. And this quantity includes allowances for normal wastage, spoilage, and other possible manufacturing inefficiencies. Standard cost for direct labor. The standard rate per hour is the rate that would be incurred per hour of labor time. And it includes not just the wage rate, base wage rate, but also the additional costs of employment insurance, employee benefits, and other related labor costs that the employer has to incur. The standard hours per unit represents the time, the labor time that would be needed to complete a single unit of product. And we make allowances for breakdowns, machine downtime, cleanup, rejects, and other normal inefficiencies. Standard costs for variable overhead. Basically, we calculate a standard rate, which is the equivalent for the variable portion of the predetermined overhead rate. And the standard rate multiplied by the input hours, could be direct labor hours or machine hours, gives us the standard cost for each unit. The standard cost card indicates the quantity and costs of input needed per unit of output. So here you can see an example of a standard cost card, which shows the inputs, direct materials. For example, 3 kilograms of direct materials are needed, or should be needed at a standard price of $4 per kilogram. 3 kilograms multiplied by 4 gives us $12 of direct materials needed to make 1 unit of output. Likewise, for direct labor, 2.5 hours of direct labor time at $21 per hour works out to $52.50 for each unit of product. And variable manufacturing overhead looks like it's charged based on direct labor hours, 2.5 hours times 3, $7.50. So the total standard variable cost per unit of product is $72. Now, there's no particular significance of these numbers in here. It's just an example of what a standard cost card would look like. And basically, a standard cost card provides the quantity of inputs as well as the standard costs per unit of input. Next, we'll talk about direct material variances. There are two variances to be computed. First one is the materials price variance. The calculation of materials price variance is the multiplication of actual quantity purchased times the difference between actual price, AP, minus standard price, SP. So as you can notice here, what's really driving the difference, the variance is the difference between the actual price paid for the materials and the standard price. If there's a difference between the actual price paid and the standard price, that difference could be favorable or unfavorable depending on how the prices are. So if actual price paid is less than the standard price, the difference will result in an overall favorable variance. On the other hand, if the actual price paid for materials is more than the standard price, then the difference results in an unfavorable value. The second variance we calculate for materials is called the materials quantity variance. And here, the variance is basically driven by the difference between the actual quantity of materials used and the standard quantity allowed for production. This calculation could be done in this manner as well. So you've got the actual quantity times the actual price, actual quantity times the standard price, standard quantity allowed times the standard price. The difference between the actual quantity, actual price, and the actual quantity standard price gives us the material price variance. And then the difference between actual quantity used times standard price and standard quantity allowed times standard price gives us the materials quantity variance. Now, it is important to keep in mind that the quantity of materials purchased, in this example here, 6,500 kilograms of materials were actually purchased, and the quantity used for production, in this example, 5,000 kilograms were used. These quantities can be different. So you need to, if you were doing your calculations in this columnar manner, make sure that you are aware of this possibility. Recording the journal entries for the materials variances. The first one is for the materials price variance. So you want to debit raw materials at actual quantity purchased multiplied by the standard price per unit of raw materials. You will credit accounts payable at the actual quantity purchased times the actual price, and the material price variance, the difference, could be a debit or a credit depending on how the actual price and the standard price behave. All right. So if we have a favorable price variance, then the difference will be a credit. If we have an unfavorable variance, the difference would be debit. The journal entry to record direct materials quantity variance includes debiting work in process, standard quantity times the standard price, crediting raw materials inventory, actual quantity used times the standard price, and then debiting or crediting materials quantity variance. Debit in case of a unfavorable variance, credit in case of a favorable variance. The direct labor variances, there's two of them as well. The labor rate variance, which is essentially driven by a difference between the actual rate per hour paid to workers and the standard rate. So actual hours times the difference between actual rate and standard rate, and labor efficiency variance, which is standard rate times the difference between actual hours and standard hours allowed. It can be calculated in this manner. You can set up a first column, actual hours times actual rate, second column, actual hours times standard rate, And then third column, standard hours allowed times standard rate. The difference between the first two columns is the labor rate variance. The difference between the second two columns is, the second and the third column rather, is the labor efficiency variance. The journal entry to record direct labor rate and the efficiency variances. You would debit work in process, standard hours times standard rate, credit wages payable for the actual hours times the actual rate. And then depending on whether they are favorable or unfavorable, you will debit or credit the labor rate variance and debit or credit the labor efficiency variance. Again, recall, favorable variance is to be credited, unfavorable variance is debited. Next, we'll look at variable manufacturing overhead variances. Here again, we have two variances. The first one is the variable overhead spending variance. The calculation for that is actual hours times the difference between actual rate and standard rate. The second variance is called the variable overhead efficiency variance. The calculation here is standard rate multiplied by the difference between actual hours and standard hours. The activity base for variable overhead could be machine hours or labor hours. In most of the examples that you'd be looking at in this course, the overhead is applied on the basis of direct labor hours. But be cautious, read the question carefully, because sometimes examination questions could be written where the overhead is applied based on machine hours and not labor hours. So be a little bit careful. Whatever is the activity base, you will use the hours for the time for that activity base. And then the variable overhead rate uh, is specified in the standard cost card on the basis of the activity base. The calculation could be done in the columnar manner, and it looks very similar to the calculation for the labor variances. You have actual hours of input times the actual rate, actual hours times the standard rate, and then standard hours allowed times standard rate. The difference between the first two columns is the spending variance. The difference between column 2 and column 3 is the efficiency variance. Finally, we look at fixed manufacturing overhead variances. Again, we have two variances here. First one is the budget variance, which is calculated as the difference between the actual fixed manufacturing overhead and the flexible budget fixed manufacturing overhead. The second variance is called the volume variance. And the calculation here is the difference between the flexible budget fixed overhead and the fixed manufacturing overhead applied to work in process. The fixed manufacturing overhead applied to work in process is calculated by multiplying the standard rate times the standard hours allowed for production. The calculation can alternatively be done by multiplying the fixed overhead rate with the difference between the denominator hours and the standard hours allowed for production. So in a columnar manner, this is what the calculation would look like. In the first column, we'll have the actual fixed overhead cost. Second column would be the flexible budget fixed overhead cost. And the third column would be the fixed overhead cost applied to work in process, which is essentially standard hours times the rate per hour for the fixed manufacturing overhead. So in order to demonstrate how the calculations are done, I will work through problem 10-21. And this is the details provided in the problem. So Clarissa McWhirter, the vice president of Cypress Company, is happy to see a very small variance on the income statement after the company having gone through some trouble in controlling manufacturing costs. She notes that the overall manufacturing variance of $12,250 was well within the 3% limit that had been set for variances. Then we are given information about the company's product. They make a single product, and the standard cost card is given in the first blue chart there. The product per unit of the product needs direct materials, 4 meters, and the standard price is $3.50 per meter, giving us $14 for each unit of product for direct materials. Direct labor, 1.5 direct labor hours ought to be required, and the standard rate is $12 per direct labor hour. 1.5 times 12 is $18 per unit of product. Similarly, there's numbers given for variable overhead and fixed manufacturing overhead, giving us a total standard cost of $44. Then there's additional information provided. The company manufactured 20,000 units of product in the year. Total of 78,000 meters of material was bought during the year at a cost of $3.75 per meter. All of this material was used to manufacture 20,000 units. There were no beginning or ending inventories for the year. Now, in a typical examination problem, you will likely have some beginning and ending inventory information provided. The company worked 32,500 labor hours during the year at a cost of $11.80 an hour. Overhead cost is applied to products on the basis of standard direct labor hours, and you're given data pertaining to manufacturing overhead below. The budgeted direct labor hours for the year were 25,000. That's what is meant by the denominator activity level. The budgeted fixed manufacturing overhead costs were 150,000. The actual fixed overhead costs for the year came in at $148,000, and the actual variable overhead costs for the year were $68,250. So first, we'll calculate the materials variances. To compute the materials variances, we need some information handy. We need the actual quantity of materials that was purchased. So in this problem, 78,000 meters. We need the actual quantity that was used for production. Keep in mind that the actual quantity used for production will not always be equal to the actual quantity purchased. So the computation of how to get the actual quantity used for production is you take the beginning inventory, add actual quantity purchased, and subtract the ending inventory of materials. In this particular problem, there were no beginning and ending inventories. So therefore, the total actual quantity purchased ended up being the actual quantity used for production as well, 78,000 meters. The company produced 20,000 units. So standard quantity allowed for production, the 20,000 units produced multiplied by 4 meters. We get that from the standard cost card, 80,000 meters. The actual price paid per meter is $3.75. The standard price per meter is $3.50 a meter. Now, when you look at the actual price and the standard price, you see that the actual price is more than the standard price. So we can predict that the materials price variance will be unfavorable. Why? Because for every meter that was purchased, the company paid 25 cents more than the standards allow. For a total of 78,000 meters purchased, the materials price variance is therefore $19,500 unfavorable. Actual quantity purchased multiplied by the difference between the actual price and the standard price. 25 cents times 78,000 meters is the 19,500. And because our actual price paid is more than the standard price, this variance is unfavorable. Likewise, if you look at the quantities, the actual quantity used for producing 20,000 units is 78,000 meters compared to 80,000 meters allowed under the standards. So the company got the work done by using fewer units of raw materials, so 78,000 compared to 80,000. So the difference here, the variance here for the materials quantity will be favorable. And so this 2,000 meters saved in production multiplied by the standard price gives us the materials quantity variance. The price variance is usually the act of purchasing the raw materials is the responsibility of the purchases manager. So the purchasing manager is charged, is tasked with making sure that they buy materials of appropriate quality and at competitive prices. The actual use of those materials for production, though, occurs in the factory, and the production manager is in charge there. So when we calculate the materials quantity variance, we have to keep in mind that we should only be looking at the difference between the actual quantity and the standard quantity, holding the standard price. Don't use actual price here, use the standard price. Why? Because the production manager is not responsible for the prices paid for the material. That was the responsibility of the purchasing manager. Overall, the variance for materials is 19,500 unfavorable plus the 7,000 favorable. Now, unfavorable and favorable cancel out, so you are left with 12,500 unfavorable in total. The labor variances, we need a few inputs for there as well. The actual hours worked, which in the problem we were given 32,500. The standard hours allowed for production. So each unit at standard should take 1.5 hours of labor time. So 20,000 units actually produced, multiplied by 1.5 hours gives us 30,000 hours. The actual wage rate paid is $11.80 per hour. The standard rate is $12 per hour. So comparing the actual rate to the standard rate, the actual rate is 20 cents cheaper than the standard rate. Hence, we get a favorable labor rate variance. We worked a total of 32,500 hours. Saving 20 cents compared to the standard rate gives us favorable labor rate variance totaling $6,500. However, looking at the number of hours taken to complete the production, the actual hours taken is 32,500 compared to a standard of 30,000 hours. So the production took 2,500 hours more than the standards permit. At a standard rate of $12 an hour, that's an unfavorable labor efficiency variance of $30,000. The total labor variance is $6,500 favorable, $30,000 unfavorable, or a net $23,500 unfavorable. For the variable manufacturing overhead variances, we need to look at what the variable manufacturing overhead is applied based on. In this problem, it was told that variable manufacturing overhead is applied on the basis of direct labor hours. So we will use the actual hours and the standard hours from direct labor. So actual hours, 32,500, standard hours, 30,000. The actual rate for variable manufacturing overhead was not given to us specifically, but we were told that the total variable overhead was 68,250, and given the actual hours of 32,500, we get an actual spending rate of $2.10 per hour. The standard rate is $2 according to the standard cost card. So here we look at the actual spending rate, $2.10, and compare it to the standard rate of $2. We see that the actual rate is more than the standard rate. So 10 cents more for every hour. For a total of 32,500 hours, we get an unfavorable spending variance, $3,250. There is no efficiency for variable overhead on itself because the actual hours for labor were 32,500 and the standard hours allowed for production were 30,000. We ended up with an unfavorable labor efficiency variance. And since variable manufacturing overhead is applied based on the direct labor hours, we will also get an unfavorable variable overhead efficiency variance. So that works out to $5,000 unfavorable. The total variance for variable overhead is $3,250 unfavorable plus the $5,000 unfavorable, giving us a total $8,250 unfavorable variance. Looking at the fixed manufacturing overhead variances, the denominator hours for this company were 25,000. The standard hours allowed for production work out to 30,000 hours. The standard rate, according to the standard cost card, was $6 per hour for fixed manufacturing overhead. The actual fixed manufacturing overhead was $148,000, and the flexible budget fixed manufacturing overhead was given at $150,000. Now, for the budget variance, we compare the actual fixed manufacturing overhead to the flexible budget overhead. Given the fact that our actual fixed manufacturing overhead was lower than what was budgeted for, the budget variance is a favorable amount. Now, the fixed overhead applied during the year is calculated by multiplying the standard rate, $6, by the standard hours allowed. We get 180,000. So when we calculate the volume variance and we look at the budget variant, the fixed manufacturing overhead budget is $150,000, and the fixed manufacturing overhead that's applied to work in process, 180,000, that difference will be a favorable volume variant, $30,000 favorable. We could alternatively have calculated the same amount by taking the standard rate of $6 and multiplying it with the difference between the denominator hours and the standard hours. Denominator hours were 25,000, standard hours are 30,000. That's a difference of 5,000 negative. Multiply that by $6 an hour, and we get $30,000 favorable for the volume variance. So the total variance for fixed manufacturing overhead is therefore 2,000 favorable for the budget variance, 30,000 favorable for the volume variance, for a total of $32,000 favorable. If we were to add up all of the variances that we've computed, so for materials, we had a $12,500 unfavorable variance. For labor, it was $23,500 unfavorable. Variable manufacturing overhead, we had $8,250 unfavorable. And fixed manufacturing overhead were $32,000 unfavorable. When you add up all of these variances, yes, the total variance for the company does indeed work out to $12,250. It's unfavorable, but mind you, the $12,250, according to the problem, was within the 3% control limit. However, what is important to keep in mind is that the total variance, although it is within the 3% limit, the reason for that is because it's entirely due to the favorable variance on manufacturing overhead. And what's driving that predominantly is that the company actually produced more units than were originally budgeted for. Uh, the company produced 20,000 units compared to what they were budgeting for. Recall the denominator hours were 25,000, and each unit needs 1.5 hours of labor time. If you divide the 25,000 hours by the 1.5 per unit, the company was only budgeting to produce 16,667 units. Now, that did result in a favorable fixed manufacturing overhead um, volume variance, but that was due to the fact that the company charged or applied fixed manufacturing overhead on the basis of standard hours allowed. All right, if that hadn't happened, we would not have had a favorable variance on account of the volume. If you take away the $30,000 volume variance, favorable volume variance, then the total variance turns out to be a much bigger and unfavorable number. So we have to keep that in mind. And when we look at the large unfavorable variances for both labor and materials, it is a little bit of a stretch to say that we should be congratulating everybody in the company for a job well done. It, Clarissa McWhorter, the person at the company there, does not appear to understand what was really driving the total variance. Okay, so if we were to try to explain the variances, we should consider all variances because there could be interconnections between them. For example, if we have a favorable direct materials price variance, it could mean that we paid less for the materials than the standard cost. I mean, that is what the meaning is. However, did we really get a good deal and hence paid a lower price? Or did we get exactly what we paid for? You know, we paid less, hence we had substandard material quality. So it may be a good idea to consider the direct materials quantity variance as well. If we have a direct material quantity variance that is unfavorable, then that could be an indicator of poor materials quality. Or maybe the workers were being careless in using the materials. We don't know what was really happening without looking at the labor variances. So then you should look at the labor variances as well, and see if maybe the labor efficiency variance was unfavorable, or which way did it go. For the labor rate variance, if we get a favorable labor rate variance, it simply means we paid workers less than the standard wage rate. Now, the reason for that is that because we hired workers that were less skilled, or did we get a lower wage rate because the economy being softer, we were able to hire workers at a lower wage rate? We can't say for sure unless we also consider the labor efficiency variance. Now, if you get a favorable labor efficiency variance along with an unfavorable materials quantity variance, we could speculate that the workers were likely working too fast and therefore ended up wasting materials. Or, again, we don't know, maybe the workers were fine, but the materials were actually not of good quality. So what I'm trying to communicate here is that when we go through the variances, we may come up with some possible hypotheses for what is driving the variances, But that should just be a starting point. It should initiate a conversation. And as managers, you would want to hold those conversations, have those conversations with the people in charge, and try to get a sense of why things turned out the way they did. I've already talked about the variable efficiency variance, the variable overhead efficiency variance. It's meaningless on its own, all right? And all it indicates is the indirect effect of the efficiency or inefficiency of the use of the activity base. So could be direct labor, could be manufacture the machine hours, the effect of that activity base on the overall variable overhead costs. The fixed manufacturing overhead volume variance indicates if the company produced more or less than the budgeted production volume. If the company produced more, we'll end up getting a favorable volume variance. If the company produced less than how much they budgeted for, then we'll have an unfavorable volume variance. What ends up happening is that the company, in using standard costing, applies fixed manufacturing overhead on the activity base, so based on direct labor hours or machine hours. In reality, fixed costs are not variable. So this is basically an error on the part of company management treating fixed manufacturing overhead costs as if they were variable. All right, so in the example we worked on, problem 10-21, there was a large favorable fixed manufacturing overhead volume variance. That volume variance was simply the result of the company applying fixed manufacturing overhead costs to work in process on the basis of standard hours allowed. There was no correlation to the actual cost drivers there. The actual fixed overhead cost was a totally different number. So this fixed overhead volume variance can sometimes skew the results one way or the other and should be treated with utmost caution. That's all I had for the lecture video on chapter 10. In class, I will be going through a couple of additional problems. We'll go through problem 10-20 and problem 10-31. Until then, take care.